Hello traders, today we'll be discussing about moving averages. Now we'll be discussing about what is moving averages, types of moving average, different periods of moving average, and what are the use of moving average and how do we use them. Now before we start, if you haven't subscribed to our channel yet, then please make sure to hit the subscribe button down below and also give this video a thumbs up. We do live trading every day on the London session and also on the London and New York session overlap. So if you want to trade with us live, then make sure to subscribe and stay tuned. So the basic idea of moving average is that it's a technical indicator showing a line like this, and if the price is above the line then the market is bullish, and if the price is down the line then the market is moving in a downtrend. Now what it does is that the price doesn't always move in a proper trend, making proper pullbacks and stuff like that. So what happens is that price in the market, price makes a lot of fake outs, a lot of stop loss signs, and there's a lot of market manipulation that caused by big time traders. So moving average shows you moving average removes this kind of market manipulations and shows you an average move of the market, whether the price is moving in a uptrend or whether the price is moving in a downtrend in the long run or in the short term as well. So there are different types of moving averages. One is the most important ones are simple moving average, weighted moving average, and exponential moving averages. Now first of all, simple moving average. So simple moving average, let's hide the EMA. Simple moving average, or SMA, is basically a moving average that focuses more on values more on the old price changes in the market and shows you an overall idea where the price is moving in a long-term point of view. So most of the position trader or the traders that want to hold their positions for a long time, those are the kind of traders really look into SMA or simple moving averages. Now on the other hand, EMA or exponential moving averages, they focus more on the recent price changes in the market. So there are different periods of moving averages. Universally people uses 10 to 20 periods of moving average for short-term trading. If you're looking for a short-term trades, then you should set your periods from here from 10 to 20 EMA, or if you're looking for a midterm, then you should set your period to 50, and if you're looking for a long term, then you can set your period to 200 EMA. But it doesn't have to be the way I described or the way everyone does it inversely. You should tune this number of periods and see which periods of moving average the pair that you're trading really respects well. What I mean is that let's see. You see, okay, let's hide this. Okay, so in this EMA you see let's change this moving average to 20 or 30. Okay, let's set it to 20. So if you set this moving average to 20, you can see the market doesn't respect this moving average that much, because you can see all these movements where the moving average was crossed below, but the price didn't move to a downtrend. It moved again on the uptrend like this way. So you can see another right here. So in that case, you should increase the period a little bit. Let's set it to 60 and see if the market values that period more. You see, now the market respects this moving average better, because you see all this retest on this moving average, and after the retest the price moved up like this. This moving average isn't showing that the price is moving in a downtrend until it really did move in a downtrend. So obviously this period of moving average is being respected by this pair even much better than that of 20 period moving average. So that's how you can tune this moving periods of this moving average, or increase it or decrease it, the number of this period, and see which period of moving average the market really respects, and that's how you select the periods of the moving averages. Now let's talk about why do we use these moving averages. Now there are multiple uses of these moving averages. Obviously the main one would be to identify trend direction. Now with the use of moving averages, let's pull out our SMA moving average, you can obviously tell which direction that trend is actually heading in the long run. So if you look at this SMA or moving average, you can see the MA or SMA line is way down than the price like this. So that is a clear indication that the price is moving in an uptrend, and even for a long term like this. And when the price changes direction, we started going to a downtrend, the moving average just went above the price like this, showing the price is moving in a downtrend. That also happens in EMA too, so like that. But though the moving average is a lagging indicator, it is also known for a lagging indicator, it doesn't show you the price movement in advance. It just shows you like what the price is actually doing currently, and also what the price did in the past times also. So use it accordingly. Now you can also identify the change in the trend direction with moving average crossovers. What I mean is that you should pull out two moving averages for this. Okay, we got a EMA of 60 periods right here, and we got a MA of 100 periods right here. So we put two moving averages right here. So when the so you see like as price is moving in an uptrend, both of the EMA and MAs are under the price, like they are moving downside at the price. But as soon as the price changed its trend direction, it went above. So before doing that, the both of the moving averages crossed over right here. So that is what I mean, like when two of the moving averages like this crosses over each other, there is possibly a sign that the price is changing its direction. Okay, so if the price is moving in an uptrend, then both of the moving average crosses each other, then it's a sign that the price is moving in a downtrend. And if the price is in a downtrend and then it both of the moving average crosses each other, then it's a sign that the price is changing its direction to an uptrend. And that's what it did. You see again, like after moving a bit in the uptrend, the price again crossed over the moving average, both of the moving average again crossed over each other, and the price started moving in a downtrend. So that's how, like with the crossovers of moving averages, we can decide when the price is actually changed its direction. That's how. So next we can use the moving averages to identify support and resistance, or the price action. You can use it as a price action tool like this way. So you can see, let's hide this SMA for a minute. So on the EMA, you can see the price retested this moving average at this point. So you can just draw a zone right here, and when you draw a zone right there, you can see that the price formed a key zone right here. The price retested at EMA, which also happens to be a pretty strong key zone on the price action perspective. So again, you can draw another zone on this retest of moving average like this here. Okay, let's draw a zone. Okay, so the price retested the moving EMA, the moving average, again right around here. Okay, so which also happens to be another key zone in the price action perspective. You see all these retest points here, here. So all the retest points that the price does on the EMA most of them turns out to be at pretty strong key zones. So that's how you can guess, like by drawing zones on the retest of the price on the moving average, you can draw some zones about support zones and also resistance zones right here. So that's how you just identify support and resistance with the use of moving average. Now you can better time your entries and also ride massive trends with the use of moving average. What I mean is that so you can just wait for the price to retest on the moving average. Like you see, we can already see, like if you pull out a moving average and set its period, tune its periods by seeing like which of the periods of moving average the price is actually respecting. So by pulling out such moving average, you can wait for the price to retest on the moving average, and then you can make your entry. Like let's say as the price retested this moving average at this point, you entered right here on the retest of the moving average right here. In that way, you set your stop loss just below the retest point of the moving average. So in this way, you get to risk a lot less and set your TP even further. So that's how, like with the use of moving average retest, if you enter on the moving average retest, you can set a really small stop loss and high TP. So that's how you better time your entries. You know where to enter, a better place to enter with the use of moving average retests. Then you can ride massive trends using these moving averages. So what I mean is that let's say you took an entry right around here, like this. Okay, let's say you took an entry right around at this point right here. Now after you entered here, you set your stop loss right around here. Now let's say after you took an entry, the price started going up like this. Okay, Now where should you move your stop loss to? Okay, you know that you're thinking that the price will move further in an uptrend. So how should you set your stop loss to ignore the market manipulation and to keep your position open until the price actually changes trend direction? So how should you do that? How should you trail your stop loss just behind the price so that you can ride these massive trends up ahead, all the way up, like around here? So how do you do that is that you wait for the price to go up and again retest the moving average right around here. Okay, you wait for another retest on this moving average, and that's where you'll move your stop loss to. Like let's say you took your entry right around here and price started moving up. You waited, then waited, and when the price made a retest again on the EMA, then you move your stop loss just below the retest point on the EMA right around here. So again, like you're waiting, the price made another retest on the moving average, like going up a little bit, then you move your stop loss just below that again. So that's how, by trailing your stop loss just below the moving averages, like around like this way, you can like actually ride these massive trends until the price actually changes trend direction right around here, which you can also get by the moving average crossover that we just talked earlier. So that would be all from me about moving averages. Now I will talk about my personal opinion on using moving averages in your trading. So you should use moving average in combination with other price actions and also chart patterns and other stuff that you use, like on the trend lines, Fibonacci retracements, etc. Okay, don't just blindly trade just because the price retested on a moving average and stuff like that. We already talked about it. Like you also look for if the retest points on the EMA is also a strong key zone. In that way you increase your chance in winning in your trades. Like at this point, you see this retest points on the moving average is also a pretty strong key zone. So you get two confirmations. One is that price retested a moving average, and another is that price retested a strong key zone. Again, on this point, like on this retest, you can see on this retest of moving average, you can see that the price retested a moving average and also retested a pretty strong key zone at this point. So that's how, by combining price actions, that's how you use your moving average. So that's it from me on moving average. I hope you guys found any values in this video. So if you did, then make sure to subscribe to our channel and also give this video a thumbs up. And if you have any questions, then just ask us in the comment box below. We'll be happy to help you guys. So that's it for today's video. We'll see you again on the next video.